Welcome back. Home buying demand has dropped to the lowest levels since 1995, a 28-year low as mortgage rates are around 8% right now. Here's a new report I want to share with you guys, just announced today, which is October 4th. And by the way, in today's video, I'm going to share some leading indications of home buying demand so we can gauge which direction our U.S. housing market is headed. And of course, I'll have an update for you guys regarding rates as well. So according to the MBA, which is the Mortgage Bankers Association, applications decreased by 6% compared to last week. This is actually for the week ended September 29th of this year. So they have what's called their refi index plus their purchase index. So overall applications decreased by 6%. That includes refis, but also applications to buy home loans as well. So purchase applications. So for the refi index, decreased by 7% compared to the previous week and was down 11% compared to the same week 1 year ago. Of course, it makes sense that we're seeing a lack of refis given the recent surge in rates. The seasonally adjusted purchase index, a measure of the amount of people submitting loan applications to buy houses, decreased a whopping 6% compared to last week. I haven't seen a big decrease like that in quite some time. Usually it fluctuates in the range of 2 to 3 to 4% and not 6%. It also fell by 22% from 1 year ago. According to Joel Kahn, who's the MBA's vice president and deputy chief economist, he stated the following here. Mortgage rates continued to move higher last week as markets digested the recent upswing in treasury yields. Speaking of treasury yields, take a look at this because the 10-year is at 4.743%, excluding yesterday, which was Tuesday. This is the highest levels going back to the year of 2007. And of course, the yield on the 10-year is loosely tied to mortgage rates, which I'll share an update with you regarding that here in a little bit. In any case, going back here, it says rates for all mortgage products increased last week. The 30-year fixed rate increasing for the fourth consecutive week to 7.53%, the highest rate since the year of 2000. Again, this is based on weeks 1 week ago, but rates have been increasing by about 30 basis points this week over the past 3 days. As a result, of course, applications grounded to a halt, dropping to the lowest levels since 1996. That includes refis plus purchase applications. However, purchase applications fell to the lowest levels since 1995 as the rapid rise in rates pushed an increasing number of potential home buyers out of the market. If you guys are curious to see how houses been fluctuating over the past several years here, actually over the past 10 years here, let's just look at this because this is their Composite Index by the MBA, which measures the amount of people submitting loan applications for refis, but also purchases. And that is the gray shaded area. The orange line here is your average 30-year fix. I believe that's according to the MBA. So back in, let's call it November of 2020, your average rate was at 2.7%. Now it's actually over 7% right now. So because rates have been absolutely spiking, of course, we're seeing a huge decrease of applications for home loans. And the current levels right now at 186.6, that's their composite index, is of course well below the peak we saw back in March of 2020 when their index was actually over 1,000. A huge decrease of applications for refis, but also for purchases. In regards to refis, take a look at this because refis spiked in 2020 through 2021 and then fell off a cliff once rates started spiking here. So their current index is around 412 compared to the giant increase of 6,419 that was set back in March 9th of 2020. A very low number of people refining. And I actually read an article recently that stated that 9 out of 10 people who are refining right now are pulling equity out of their houses. And also their interest rate has increased by about 2 percentage points. And I thought about including that in today's video. Instead, I'll make a separate video regarding that, regarding the number of people who are refining and taking equity out of their houses. Also, their purchase index, which again is a measure of people submitting loan applications, has also fallen off a cliff as well, the lowest level since approximately 1995. as rates have been spiking as of late. Now, speaking of rates, take a look at this because according to Investopedia.com, as of today, which is October 4th, your average 30-year fix, again, for people with great credit, is at 8.14%. FHA is at 8.24%. Just absolutely crazy. This, by the way, includes only people or average rates for people putting at least 20% down. So your loan to value is 80%. So if you're buying a house, you're putting 20% down, you're going to get the best rate here. It also includes people who are have a FICO score in the range of 700 to 760 and also paying no points to pay down their rate. I mentioned that because a lot of people would not qualify for the best rates because a lot of people do not put down 20% down to buy a house, for example. And some people, of course, are paying points or have a FICO score of less than 700. Also, have a look at this. Just kind of take this in consideration when looking at refi numbers. Typically, your interest rate that you pay is higher than if you're going to be buying a house. So their purchase rate or the average rate to buy houses right now is at 8.14%, but for refi is at 8.49%. FHA is 8.3% and VA is at 8.14% for people who are refinancing their mortgages. And obviously the rate right here is a little bit lower compared to refi rates. Also, I did a quick Google search of mortgage rates, and here's what Google had to say here. For 20% down in California with a FICO score of 740 to 759, you typically get the best interest rate if you have a FICO score over 740. They're quoting the average 30-year fix at 8.21%. Absolutely insane. But according to the Mortgage News Daily, as of today, which again is the, October 4th, your average 30-year fix is at 7.74%, an increase of 2 basis points compared to yesterday. And that rate, by the way, is the highest levels since November of 2000. That, by the way, is roughly on par with jumbo rates as well at 7.75%. And FHA and VA loans is around 7.15%. 1 year ago for a 30-year fix, you were looking at a rate at 6.65%. That's an increase of about 1.1 percentage points over the past 12 months. Additionally, over the past 3 days alone, average rates have increased by 30 basis points. Last Friday, your average rate was at 7.44%. Now it has increased to about 7.74%. Okay, let's change gears slightly here and talk about some more leading indications of home buying demand. Here is Google searches for homes for sale. So their index right now is at 73. 1 year ago, it was at 82. This means there's more or less an 11% decrease in the amount of people searching for homes for sale on Google. Also, according to showingtime.com, for the week ended September 29th, the number of real estate showings nationwide, or actually in North America, has decreased by 9.7% compared to the first week this year. Compare that to the same time frame last year, it was down a whopping 23.6% compared to the first week last year. Again, a friendly reminder, each of these metrics here, or these percentages, is based on the change compared to the first week of that year. So back in 2022 in January, or just say the first week of 2022, overall housing demand was fairly high. I compare that to the first week this year though, overall activity was very low. So just keep that in mind because this is not looking at the total number of real estate showings compared to each year. It's compared to the first week each year here. And I mentioned that because that's one of the reasons why we're only down by 9.7% this year compared to the giant decrease of 24% at the same time last year. Here's another report I want to share with you guys today because according to Black Knight, and by the way, they are a data analytics firm that supports the real estate and mortgage industries here. They reported just a few days ago, or a couple of days ago, that home prices set another record high in August. One thing I'm going to briefly touch on this report here, but one thing you guys should be aware of though, When I'm talking about, or when I report on closed home sales, that's a lagging indication of our housing market, what our housing market was like approximately 1 to 2 months ago when the home buyer got their offer accepted. So when talking about home prices or closed home prices for the month of August, this is based on contracts being signed between buyers and sellers in July and also in late June. So what happened then? Look at this, because back in June, your average rate for a 30-year fix, according to, Freddie Mac, was at 6.71%. Then in July, it was at 6.84%. The majority of closed home sales and also home sold prices in August is based on contracts being signed in July, some in late June. Let's just call it for the majority in July. That was when the average rate was at 6.84%. Look at this though. August, average rate increased to 7.07%. And then in September, increasing again to 7.20%. So just keep that in mind when talking about how home prices reach another all-time record high in August. That's based on rates at around 6.8% and not the over 7% rates we're seeing today. In any case, hope that makes sense. But according to Black Knight here, home prices rose an exceptionally strong seasonally adjusted 0.68% increase from July. August's non-adjusted gain of 0.24% was more than 60% larger than the 25-year same month average, which was a gain of 0.15%. That is a lot there. So let me just kind of digest this for you guys. So in August, the gain non-adjusted was a gain of 0.24%. That's a change compared to July. The 25-year average from July through August each and every year, the 25-year average there was a gain of 0.15%. So the gain we saw this August on a month-over-month basis is a little bit higher compared to the historical averages over the past 25 years. They also say here, along with a lower starting point due to late 2022 price drops, I'll explain that here in a little bit. August's increase was enough to push the annual rate of home price growth on a national level by a gain of 3.8%. That's August compared to August last year. That's up from 2.4% year over year that we saw in July. And of course, much higher compared to the 0.25% increase we saw in May this year compared to May last year. Now, here's a note added though, because we're talking about the year over year change up by 3.8% this August, right? The annual change is actually up due to two main reasons. Number one, due to low supply. In other words, we have a historical low inventory levels in the number of houses for sale. That's supporting home price growth that we're seeing today. But number two, though, due to the sharp pullback in prices that we saw back in late 2022. So because prices were basically going like this, we're not seeing that same pullback in prices this year. We are seeing prices decrease, but not the same levels we saw back in 2022, which is one of the reasons why we're still up by 3.8% year over year. They also say here on a national level, prices set a fourth consecutive monthly record and are now 2.5% above the 2022 peak on a seasonally adjusted basis, with 2/3 of major US markets having surpassed their previous all-time record highs. They also mentioned that the price gains is very much widespread as well, as prices in nearly half of the nation's 50 largest markets climbed by 0.75% or more compared to the previous month. They also mentioned here that if adjusted home prices were to freeze, in other words, if home prices were flat for the remainder of the year, we should expect prices to be above 5% by year end compared to the first week this year. I will say that that's probably unlikely because we typically see each and every year that home prices tend to decrease in the second half each and every year. So I wouldn't say this is actually going to be a probability here, but just something to keep in mind here. They also say here that all that said, or however, closed sales from August would have typically gone under contract in July, as I mentioned, when rates were much lower. As it stands, housing affordability hit yet another 38-year low in September by way of spiking rates and of course prices as well, both of which could still serve to cool price gains as we move toward the end of the year. With that said, please comment below with your biggest takeaways from today's video. My biggest takeaway is that average rates have increased to the highest level since November of 2000, which is absolutely insane. Average rates for people with great credit is in the range of 7.7% to 8.1% right now. If that sustains at these very high levels, we should expect to see closed home sales to absolutely plummet later this year due to high rates, high home prices, and of course, due to affordability constraints. And of course, our housing market tends to slow down each and every year towards the holiday season here. That's my biggest takeaway from today's video. But what do you guys get out of this video? Of course, please leave me a comment below. I hope you have an awesome day and I look forward to seeing you on the next video.